All right, so I'm going to do a quick tutorial on one way there is to improve your portfolio performance. So if you have a portfolio of stocks, or if you're a day trader and you have some trading system or strategy, or you're just holding an asset for the day, this can help you improve your performance based on your Sharpe ratio. And I'll show you real quick. I'm using it actually for algo trading. I'm a quantitative trader, so I write computer programs that trade for me. And I'm using it with this. This also uses some machine learning to optimize, but I'm using risk parity to improve my performance as well. And I'm showing you how to use this because it's easy to calculate. You don't need computer programming knowledge or anything. You can probably do it just on pencil and paper. If you can't do it that way, then you can do it with Excel. So let me start with some terminology. Standard deviation is risk or volatility. We're going to want standard deviation as a percentage, so divide it by the mean, and that'll tell us how volatile as a percentage of our asset's price or value or allocation. So if you don't understand this, look up a quick tutorial, but I'm assuming most people know this because it's Algebra 2 level math. So if you don't know this, search it on Wikipedia, or if you want to, Khan Academy is another resource. But we're going to use it to find our volatility/risk. Okay, next one. Pearson correlation coefficient. How correlated two assets are to one another. So it will give you a number between 1 and -1. The closer it is to 0, the closer to uncorrelated the assets are. If it's positive, the assets move together. So that implies -1 would mean they don't move together. It's the opposite. They move inversely. So like gold and stock prices sort of move inversely. So they would probably be closer to -1. Gold and like the S&P 500. But maybe two companies like Target and Walmart would move closer to 1. And then maybe two currencies that are highly correlated, like the Australian dollar and the New Zealand dollar, they would probably have a positive correlation. So you can see how this could become useful later on. So now next is, oops, I accidentally bumped that. All right, so a whole cup of matches. So we're going to go next to Sharpe ratio. And this is a method for grading the quality of your asset. So it's basically return over standard deviation of return. So your average return of an asset, A, over the standard deviation that we mentioned here of asset A. And if you have a stock portfolio strategies for some day trading that you're using, systems for currency or commodity trading, doesn't matter. We're just going to call them an asset for simplicity's sake. So we'll have two assets on here. So this is our little chart. We have standard deviation going this way, return going this way. So if we have an asset with a risk of 4% and a return of 5%, leveraging it won't increase our Sharpe ratio. And if they charge interest, it could actually decrease it. It would shift the line down because it would decrease our returns. But if we assume it doesn't cost us anything to increase our leverage, like with a commodity or forex system, it wouldn't cost any more. It would be the same interest rate usually. Then we can increase our return proportionally to our risk. And that's why I've drawn this line here. So let's say we have another asset on this line that it's basically identical. It has 10% return, and it has 8% risk. So now we're going to show how we can decide how much to allocate to each asset. Because if each cash flow asset, if they're not the same risk, so you wouldn't want to put an equal amount of money onto it, because that just isn't logical. You're taking more risk on one than another, so allocating an equal amount would have a disproportionate amount of risk. So if you want to have each amount have an equal amount of risk, you could allocate more to the lower risk asset than the high risk asset in order to balance the allocation's risk. So it'd be a risk adjusted basis. So that's what takes us to the last corner, risk parity. So I'm going to explain this math in a second, but let's assume we have standard deviation of asset A. We'll call this one here A. So that's A. This is B. B. So we have, let me think. So if we have a standard deviation of 0.4, we're going to calculate real quick the reciprocal. So the reason we need reciprocal is because right now, as a percentage, volatility as it goes higher becomes a bigger number. So our risk as it increases becomes a greater number. And if we're wanting to calculate the percentage to allocate based on risk, we want it to be a bigger number the less risky it is. And that's actually really easy to do. You take the reciprocal, and that's basically, if we do it for B, so it's basically standard deviation over 1 over the standard deviation. And that'll give us usually a whole number unless it has over 100% risk. But that'll give us a bigger number the less risky. And you'll see why that's going to be useful in a quick second. Let me calculate though those values. So let's start with the asset B, 0.04. So I'm gonna type 0.04. And notice how easy it is to calculate this. I'm doing it on my Mac right now. So, 25. So we want to put down 25 for B. And then for A, we have 8% risk. And remember, these are identical Sharpe ratios. So the assets are not all that, they're identical when it comes to how good they are. They just have different risk levels. So we have 12.5 over there. And if we write these down here so we can remember them, basically what we're wanting to do is we're going to take, what this is saying is basically reciprocal of A over reciprocal of B plus A. It's reciprocal. Keep saying reciprocal, it's getting annoying, but that's an A right there. I have bad handwriting, but so basically what this tells us is how much we want to allocate to A based on the risk levels. So we would plug in these numbers, and if I go ahead and type that real quick, we can figure out how much we need to allocate to A. So A has 12.5 divided by, so let me do 12.5, and we're taking the sum of the reciprocals, and as you can see, that ends up giving us 0.33333. So we want to put a third of our money on A. And I'm not going to do the math. I'll just tell you that B will be 2/3 because that's pretty common sense. So we want our weighting for A to be 1/3. So 33%. I'll just write 1/3. B equals 1/3. Okay, or 2/3, sorry. Okay, so 1/3 and 2/3. That's how much we want to put on each cash flow asset or asset. So we just solved how much we should put on each asset. And we did it in a method that each allocation would have the same risk. So both of these, the amounts we're allocating, so the weighting B and A should achieve the same return and the same risk. And because we're allocating by risk, they will, regardless of what their return is. So no matter how much the return is, they both have the same amount of risk. So that is really what's beautiful about this. And it allows you to figure out how much you should put on each of your assets. So now I'm going to show you a quick way you could use this, let's say, in order to increase your trading performance. So let me erase everything. All right. So let's say you want to buy an energy stock. But the problem with energy is it's pretty risky. So let's say the stock has a nice dividend, maybe 7%. Something you could do is you could short crude oil. Since crude oil is a non-yielding asset, shorting it won't really lose that much money. You'll have to pay interest, but regardless, you still have, I'm having trouble holding the camera steady. You would still, shorting crude would move down. When crude moves down, you would make money. And when the stock goes up, or the stock would go down too, so you would lose. Here, I have to draw it to make sense of it. But let's say this is your stock, and crude is moving the same way. So let's say you go long on the stock, and crude is sustaining growth, but then it starts to really take a nosedive. So shorting, here, let me just say this is stock, and this is crude, so that we can make this a bit more clear. So as you can see, the stock goes up, and crude moves with it, but you're shorting crude, and crude doesn't really move much up and down because it's non-yielding, so it won't keep going up. But when it does go down, as you can see here, it would have covered you. And this is all hypothetical, but you can check it later. And when it goes up, you would lose some money, but is it worth it to have very low risk when it drops? And in exchange, your return is just a little lower. But altogether, this would increase your Sharpe ratio. So that's an example of using how you could use risk parity, because you'd have to allocate not based on an equal amount of cash, but rather risk, because there are different volatilities. So you would have to allocate based on risk parity. So that's one way you could use it. So let's have another idea is just a portfolio of systems. I'm not gonna draw it because that just takes time, but you could allocate your systems if you have, say, you're a currency trader, forex. People like to make technical analysis systems, I've seen. I don't advocate for technical analysis because I don't really believe in it based on some research I've done. But if you have like 3 or 4 systems, you may want to allocate based on risk in order to increase your returns. Oops. So I'm going to go ahead and cut this video out now.